Ladies and gentlemen, Day 2 of MoneyConf Center Stage will commence in 5 minutes. Damas y caballeros, el contenido programado para el segundo día del Center Stage de la MoneyConf comenzará en 5 minutos. Ladies and gentlemen, Day 2 of MoneyConf Center Stage will commence in 5 minutes. Damas y caballeros, el contenido programado para el segundo día del Center Stage de la MoneyConf comenzará en 5 minutos. Ladies and gentlemen, please welcome to the stage co-founder and CEO of MoneyConf and Web Summit, Paddy Cosgrave. Damas y caballeros, por favor, den la bienvenida al escenario al cofundador y CEO de MoneyConf y Web Summit, Paddy Cosgrave.
So you're all very welcome. It's quite a good turnout. Did anybody here go out last night for any amount of time? 3 people. That's a lie. I saw you out last night. So we've got some fantastic speakers over the course of today. The CEO of Funding Circle and Blockchain, the president of MasterCard, the global head of digital at HSBC, the chairman of BBVA, and lots more. Today we are starting with an expert look at lending. Data-informed decisions are better decisions, but how can we go one step further to make these smart decisions? Here to tell us more, please welcome, in conversation with Brian Hirsch of Tribeca Venture Partners, Kabbage co-founder and CEO Rob Frowine, Avant co-founder and Chief Credit Officer John Sun, Credit Tech founder and CEO Alexander Grabner-Muller, and Zest Finance founder and CEO Douglas Merrill.
Chairs, they're harder than they look.
Absolutely. Welcome, everyone. So we've got a great group here. Privileged to have 4 terrific CEOs, great companies. Just to kick off, I think the broad topic is driving better lending decisions, but you all are in different businesses, different focuses in terms of markets and different geographies in many cases. So maybe to just kick off, have you each go down the line and spend a couple of minutes talking about how your organization sort of uniquely uses data to make better decisions.
So I'm a little bit the odd man out. I'm Douglas Merrill. I'm founder and CEO of Zest Finance. We are not a lender. We make and sell tools that let lenders use real machine learning techniques to improve their lending businesses, from marketing and originations, through underwriting, through to collections and servicing, and to regulatory reporting. Because we're a platform, we're in a lot of different markets. We're in the US, we're in China, we're in Europe, we're dabbling in South America. Ultimately, for us, the cool thing about machine learning and the cool thing about the possibilities for future underwriting is to be able to capture and use better data, not necessarily kind of the weird third-party data that everyone talks about. Like I don't know that I care how many tweets you've had in the last couple hours. But there's lots of interesting data that's already inside banks and other institutions, customer service data, call data, other kinds of things that you can use if you have the right math.
So we are a lending company, consumer-facing lending company, and we're basically focusing on the customer segment that traditionally is not served well by financial institutions, also called the underbanked. And we have developed an approach that uses non-traditional data to basically derive a credit score for these customers. And I think there are, in our point of view, basically 3 core elements for doing smart lending decisions. I think the first is to identify what is the data that really helps you. In our point of view, we have made quite a lot of positive experience with bank transactional information. We actually think that if you have something like 6 months of bank history, you can pretty much forget everything else and just sort of like underwrite on that. The second thing is it's about on which data, on which sample you actually train your models. Because if if that's not representative of the population that you want to underwrite, basically, I mean, you're clearly not going to make smart decisions. And the third point is, I mean, you need to have the right technology, the right sort of like tool set of models to actually identify which are the patterns and characteristics that at the end of the day sort of like tells you about the creditworthiness. And we have, I think, done a pretty great job in bringing these new things together. And now with more than 1.5 million credit decisions also clearly shown that, yeah, its approach actually works pretty well.
Yeah, so Avant, I think interesting mix kind of what the two of you have said. Our focus is, again, really on using better techniques. We think data is more or less fungible. What's difficult is mining that data, again, out of the customer metadata that's generated, customer service reports, that sort of thing. Third-party data has become more or less a commodity at this point. But there's so much of it that you really need to apply the latest and greatest machine learning methodologies to really be able to make sense of all of it. I think long gone are really the days where you can just portfolio segment and build logistic regression models and do your risk governance off of that. A new set of tools and techniques are really necessary. And we've really invested quite a bit of time in building that into our underwriting infrastructure, similar to kind of what Douglas has said, being able to use different credit decisions, almost different decisioning tools at different decision points to guide your entire customer lifecycle.
So my name is Rob Frohine, I'm co-founder and CEO of Cabbage. Cabbage started out as a direct lender to small businesses in the U.S. We've expanded to include licensing our platform to banks globally to provide capital in the same way Cabbage does in the U.S. and foreign markets. So we're live in Australia, Spain, UK, Canada, Mexico, and we're launching 2 other European territories over the next 6 weeks. I think and look, we utilize a lot of the same, so I'm not going to repeat the same things my colleagues here have repeated. I think the additional thing that we do that is really key to the success of Cabbage is we require each customer to give us electronic connectivity to key data accounts on how they run their business. So think of that as not just bank data, but also processing information, social, shipping, accounting data. And by having that direct connection, it not only allows you to make a decision on that customer at the moment that they qualify for a loan, but you stay connected to that. So it has fundamentally changed our product into a line of loans that we provide to the customer and they can take on a repeated basis. When you drive, when data is utilized not just for underwriting, but for the manner by which you connect to your customer, you create a great user experience. And the other 2 things that are really vital is you create a product that has a lot of repeatability to it, which dramatically drives down the cost of acquisition over time to customers. And the other thing it does, it allows us to stay fully automated. And so we have many fewer employees than a lot of our small business lending counterparts do. Typically about 30 or 40% of the employee base. And those expense bases, in addition to underwriting and bad debt, associated bad debt, are the key expenses a company like Cabbage or other lenders face.
Great. So good start. Talk about a lot of the fintech companies, some of our portfolio companies, they're very sophisticated in their use of data, but many of them haven't lived through a full credit cycle. So talk, maybe each of you could touch on how you work internally to make sure that whatever secret sauce or mousetrap you've built can work when the shit hits the fan. Maybe Douglas?
Sure. Yeah. So one of the core problems with machine learning models is that they're meta unstable. They don't really want to do the same thing for very long, and that creates a great deal of short-term risk, let alone an actual event risk. On the other hand, it allows you to measure the short-term risk, so you can understand the event risk. We weren't making loans. We don't make loans now. We weren't making loans in 2008. We weren't selling our platform in 2008. So anyone who sits up here and says, any of us who sit up here and say, we know what would happen in 2008 is clearly lying because we weren't actually there. What I think all of us independently did, though, is take one of our core models and run it across the cliff. Because machine learning models are meta unstable, our platform has a bunch of tools to kind of automatically help you notice if something weird is happening with your model, if the input scores have started changing, or the output score distribution is wrong, or latency, and all kinds of things to try and get a hint of something might be going wrong. And we did that not to find 2008, but to find an everyday twitch. It turns out, though, that stuff capped 2008. So we went back and took a bunch of lending data from a sort of a similar product to one we had from 2007 to 2011, and 2006, 2011, excuse me. And in kind of late 2006, our model starts noticing twitchiness. And in 2007, it's thrown up real flags. Hopefully we would have noticed it, but who knows? And honestly, I hope I never have to know.
Yeah. Anyone else want to touch on that?
I can actually say that we as a company, we actually experienced a recession. So we're active in Russia, and from basically 2014 to basically 2015, the country was hit by a major recession. The currency devaluated almost by half. Delinquencies was sort of like were rising. And we basically had, almost no change in our risk performance. How did we manage that? Well, I think the trick is to have very fast iterations on your models. So that means incorporate new information, basically customers repaying or not repaying, as quickly as possible. That means retraining in fast intervals and seeing basically how certain features, change over time. So pretty much what you have been saying, and adjust your underwriting based on that. We've actually seen changes in the model even before there was actually clarity around the economic situation. And I think in general, being able to iterate fast, train fast, and adjust fast helps you to, just basically change your underwriting, as quickly as possible. And I think that's one of the great merits that, machine learning and machine learning-based underwriting sort of like gives to lending companies.
Kind of an old school answer to that question. I think machine learning models, modeling in general, is great for predicting and rank ordering in a flat environment. Whenever there's any sort of externalities or external events that happen that's outside of the input range of the data that you have for that particular model, it's not going to perform well. So in addition to all of these cool data techniques and machine learning, I think lenders really still need to have the underwriting rigor and discipline that banks really have, right? So we spend a lot of time looking at our UL-EL ratios. We spend a lot of time managing to the fundamental C's of credit, looking at capacity, looking at character, looking at collateral in certain collateralized products. And in addition to that, I think one of the things that does help through any sort of economic event is your ability to collect well by offering the proper types of workouts with your customers, right? So we've spent a lot of time really building into the system a lot of flexibility that allows us to work with customers to really figure out how their situations changed and to offer them, a proper plan that really gets them back on track.
Again, just to add, instead of repeating what others have said, I think the other thing that we do is because we're connected on an ongoing basis to all of our customers' key data accounts, and again, that's authorized access that the user has given us or the customer has given us, we actually re-underwrite our customers every single day. So right now we have a book of about 600 million. We've got about 1.4 billion in outstanding credit lines available. And every day we re-underwrite our customers and either adjust them up or down based on the activity that we see in their business, how that relates to prior periods. And so we see natural changes in the availability. And what our expectation is, in addition to the items that were mentioned before, is that during times of strain in the economy where businesses are not doing as well as they were doing in prior times, you'll see that credit line availability drop from 1.4 billion to quite a bit less than 1.4 billion. So our system has a natural way of taking into account stress on a daily basis in a business's life. And we'll wake up one day and say, why is there only $500 million outstanding to our customers when there was $600 million outstanding yesterday? That's because those businesses have suffered, something in their business. Obviously, not every day lines change, but over a period of time, you do see those shifts.
Yep. And so this is sort of a data question. I think it ties into, you're all venture-backed. I guess this doesn't necessarily apply as much to you, not being a lender. But as a lender, you've got this rigorous data model. Your underwriting standards, of course, very high. Yet you're valued based on growth and originations, right? You're sitting in rooms with investors like me saying, are you hitting your quarterly numbers? What's going on? How do you balance that? How do you keep how do you think about the integrity of your systems and your credit box in light of the need for growth? And we all know the examples of some of the companies in our industry that have maybe fallen into that trap. Just start
yeah,
with
sure. No, I'll go. So you have to make sure you don't fall into that trap, right? You always have to. You know, the thing, and I spoke at this at Lendit a few months ago, which I said is a lot of lenders out there answered the wrong question when they built their businesses. They said, how can we fill the void left by banks? And so when you answer that question in starting a business, you naturally pile as much cash into that model as possible, right? Because you're trying to fill a void. The question that most lenders should have asked is, why aren't banks filling that void, right? If you ask that question, you get an entirely different answer. And the answer is because they don't know how, at least as it relates to small business lending, they don't know how to profitably underwrite and profitably operate a business to those types of small customers. And so what we've stressed in terms of explaining to investors is, we have strong growth, but it's not we grew in 2016, we grew 40 or 45%. Which was, fairly strong growth relative to the industry. But we showed much better outcomes in 2016 because of the way we run the model. And so it was actually a very important period of time for us in demonstrating that I liken it to the fact that when somebody gave me a cyclist, even though I'm not a cyclist metaphor, and they said, look, when everybody is going downhill, right, everybody's got the wind to their back and gravity to their benefit, nobody can differentiate. Right? The way to win a bike race is to attack on the steep climb. And 2016 was the steep climb for lenders in our space. And so that's really the time to show that you can differentiate. It's very hard to do, to share those ideas, in prior years when they're saying, yeah, but XYZ has grown by 300%. Why aren't you growing by 300%? And, the answer would be, well, just wait till there's a challenge in the market, and let's see how that works. 2016 really proved that out.
Yeah, absolutely. I don't want to kind of repeat the same points, but certainly as a balance sheet lender, our challenges are slightly different from the pure P2P platform guys. We're taking bottom dollar risk on basically all of the loans that we write, right? So clearly the incentives are a little more aligned towards we got to make money and we got to make a specific set of returns on these loans versus we take a certain percent of the origination as a fee and then pass it off and bundle it off to investors. And I think the way around that temptation of growth versus basic economics is really to have, again, strong controls and strong processes and make sure that you're properly accounting for all of the various risks that you're generating throughout your business. And that's kind of difficult for starting lenders because you don't have a lot of data. You don't know how your loans are going to perform, many years down the road. So it again comes back to this point of you got to look at the fundamental portfolio management metrics of what you're underwriting and make sure that you're generating a book that you think is going to be long-term sustainable.
Yeah, maybe just one thing to add from our point of view. We are setting a return targets for all the loans that we generate, and that's basically fixed. And then say how much can we originate based until sort of like we are at this return target. And one of the things that has proven quite useful is to actually put a single person in charge for the overall returns of the loans that you underwrite. Because at the end of the day, it's a complex equation where you try to optimize, acquisition cost against risk, against acceptance rate, against sort of like, the duration of the loan and pricing and all of that. And if that sort of like sits scattered across your organization in different functions, you will never sort of like find an alignment because everyone sort of like optimizes that from a single point of view. And making sure, that there's holistic accountability for profitability and have someone who can take these calls on trade-offs is, I think, just something that has proven to be extremely helpful in our case.
So even though we're not a direct lender, I'm exposed to lending growth risk because my customers use my tools, and so. Right. But it's neither here nor there. The president of my company was a longtime Capital One lending executive, and he kind of wanders around the office screaming randomly at one expression, which is, any idiot can lend $1. It's getting paid back that's tricky. And so random times in meetings, you'll like hear this dude scream this. But it's all about this point, exactly like how do you build controls that make sense to prevent you from accidentally being the idiot.
All right.
Wow.
I don't know what's going on there. So talk about, all of you use third-party data to some extent. Talk about the sort of the reliability of that data. How do you, garbage data in leads to bad analysis. How do you know that the data that you're using in your underwriting models is solid, particularly when it's coming from third parties? And then I guess, Douglas, maybe you could even touch on China. I think China would be its own unique challenges, and I think that feels like an issue that isn't discussed a lot. It's just everyone's talking about their models, but how do we actually know that the third-party data is accurate and worthwhile of use?
So it isn't accurate. So our largest customer is a deep subprime lender. They've done like 400 or 500,000, I forget, people in these sort of pay-to-loan replacements. And we've been running their underwriting since day one. And we have never seen a single applicant who had all their data complete or correct. Never a single one. So the answer I can tell you is that the third party is always wrong. You just don't know how it's wrong. But the beauty of machine learning done right is that you take multiple samples of the same thing. So you have each of the third-party data sources plus the bank CRM system plus whatever else all tell you who they think Douglas is or where they think Douglas lives. And there's data in whether they align, how they align, how they misalign. So you create a bunch of information out of the fact that you have the same messy piece of data multiple times. There's a whole bunch of cool math behind that, but that's kind of the key thing. It's the reason that models shouldn't have 25 or 50 signals in them. If they use third-party data, they should have 500 or 1,000 or 10,000 because you can't rely on the data. China's data is confusing. There is a central data repository, People's Bank. It has data on about 20% of Chinese citizens. But of that 20%, roughly 50%, the data is that Douglas has a checking account, full stop. So it's not terribly useful. A lot of the third-party data appears to be fictional. It just shows up, and you don't know where it shows up from, et cetera. And that's because of the complexity of the lending business model. So ultimately, most of our China models are getting almost all their lift from their own internal data. So Baidu is a client of ours, and they're getting a huge amount of lift out of one of the inputs to our underwriting model is their search traversal graph. It's kind of what people did when they searched and how they react and stuff, and that's a big signal into our model. That's correct because it's from them, but it's also hard to parse.
Right.
I can just completely basically agree with that. I think operating under incomplete information is something I think that just have to get used to, and being able to substitute one data source with another is I think one of the great merits, I think, compared to a traditional underwriting system where you say, well, you pull the bureau, if the bureau doesn't return anything, then you basically cannot underwrite. I think, ultimately, just also, some of the data, I think, particularly if you work with web-based data, you need to also get used to the fact that, some of the information is sort of scraped or sort of harvested over non-robust, sort of collected in a non-robust way. So just sort of diversifying your set of inputs is I think the strategy that works pretty well for us.
I think there's two answers depending on what you're using that data for, right? So we partition our data between what we can use for underwriting and what we can use for everything else. So the underwriting data has to be incredibly clean. The underwriting data is tagged specifically in our modeling data sets as can use this for underwriting, right? It less so in the UK and the EU, but in the US there's this view that you have to be able to communicate very clearly to your customers why they're getting declined, which means you really have to understand all of the input variables that are going into these underwriting models. And B, there's this concept of disparate impact, which means you have to be able to prove that the models you're using not only is not overtly discriminating against protected classes, but isn't doing it kind of in a statistically biased way either, right? So those variables are kind of kept in their own little vault, and we hand vet each and every single one of those. And then there's the rest of the variables. And Interesting point about it being accurate, right? Because what is a piece of data really? So accuracy isn't really the right concept for it. Is there a signal and is it consistent, right? So we spend a lot of time making sure that the input data stream is very consistent to what we use to build the model. Does the distribution of the attributes still look right? Does it still have the same amount of correlation to other attributes that we've seen in the past, right? And anytime that it fails one of those checks, there's a backup plan to immediately pull that out, replace it with the temporary backup model while rerunning a model without that variable in the background.
I think the only difference is, a lot of the data that we use, we access via APIs that are provided by third parties. Kabbage was really founded on the advent and proliferation of public APIs by various companies. So whether it's QuickBooks or it's Facebook or it's UPS or any of the marketplaces, eBay, Amazon, and that's heavy transaction data, and that transaction data is fairly accurate. Because it's coming from a third-party verified source. It's the actual data that they use to manage their operations, and we utilize that data on a regular basis. We also, what's also important for us, again, as sort of in addition to some of the other things that were said, is because of the sort of the continuous nature of the data we get, a lot of our insight into a customer's creditworthiness, as well as a variety of other things we look at, is based on the trend of the data. So the one area where we utilize data that really is not verified by a third party is accounting, online accounting data. It's amazing. Everybody inputs accounting data differently. They use the system completely wrong. And so we actually build a couple of different scores. We build basically a confidence score in the data and how it was entered, so we understand that, and then we underwrite them, right? So it's sort of a simplified way of thinking about it, but we have to understand whether that data source has valid data and whether it's being input in valid ways. And so we take a look at that first, and then we underwrite based on, sort of a discounting factor, if you will.
We've got 2-3 minutes left. Maybe finish up with everyone's favorite topic, fraud. We've talked mostly about sort of credit underwriting. Talk about fraud. I mean, fraud is a ever-moving target in all the markets. I've got to believe Russia. Not to pick on Russia, it must be a unique challenge. Talk about how what's the cutting edge now in terms of utilizing data to combat fraud? Where are we going? I guess maybe talk about what you're doing today. We've got limited time, and where things are going in the future. And maybe start with Rob.
Sure. No, look, we've definitely encountered fraud. I think as a company, a lot of times you hit a certain threshold, and then you realize you've got to invest a little bit more into that area. So we, a couple of years ago, had a fraud ring hit Kabbage to the tune of a couple $1 million, which is material. And it helped us sort of understand where you honestly need some of those failures in order to understand how to combat it in the first place. We look for, a lot of what we do is, because customers are connecting multiple data sources, we sort of cross-validate the data sources. If somebody is pretending to be somebody else, and they're accessing a particular account, you're not going to get capital from Kabbage by providing us with the credentials to a specific account. You've got to have multiple accounts. So most of the fraud that we've actually seen has been family fraud. So it's the grandson hitting up the grandmom's account, because you could get grandma to give him all her passwords. So those are the types of things we've seen. But we've been able to combat it both with the data that we now pull in to be able to look for inconsistencies in that data. And we also use a bevy of technologies on the front end to avoid sort of the front end application identity fraud issues that a lot of people incur.
So basically, don't share your passwords with anyone in your family. Is that?
Yeah, don't ever trust a family member.
Okay.
Yeah, I mean, family fraud and what you kind of call soft fraud, no intent to pay, are definitely a lot harder to stop than fraud rings in a lot of ways.
Yeah.
In the U.S., I don't think we've ever gotten hit by a concerted fraud ring. We've lost a couple £1 million in the UK when we first launched. And stopping systemic fraud, I think there's a lot of really cool tools out there for it. A lot of these syndicates that you can subscribe to, where there's a lot of data sharing between various groups and various parties. Device fingerprinting still works to a certain extent because it's very hard to fake a realistic-looking device. Like, you can certainly disable it, but it's very hard to fake a realistic-looking device. But the challenge is always in stopping soft fraud. So we model for that as a separate phenomenon. And the difficulty there is in recognizing what's soft fraud, what's credit, and what's hard fraud, right? So we basically go back after disposition of every single loan and have a rep kind of follow down the entire chain of what happened and try to inject some human intelligence into tagging exactly what the disposition of that loan is, just so we have clean data for underwriting.
I think we're out of time, but thank you guys. Thanks for our panelists. Just a hand for our panelists. Thank you.
Thanks.
Thank you guys for that session. It is well known by now that blockchain has incredible potential to simplify financial services and more. But what are the biggest roadblocks in its implementation? Our panel of industry experts discussed the realistic expectations for 2017. Please welcome in conversation with David Bailey of BTC, founder of the Bitcoin Foundation, John Martinez, founder of the Disruptive Group and FinTech resident expert at Oxford, Hui Nguyen Tro. Thank you.
Hello, hello. Welcome, everyone. We should have an interesting, short but sweet panel for you today. I'm David Bailey. I'm the CEO of BTC Media. We're a blockchain digital currency media group that has been covering this space since 2013. And I'm joined here today by two awesome, amazing panelists. Would you like to introduce yourself?
Yeah. Morning, everyone. I'm Hui, and I am the CEO of the Disruptive Group, which is a business builder. We build businesses in finance in Europe and in Asia. I'm also the co-founder of CFT, which is an education platform for finance professionals to help them to have the skills for Finance 2.0. And I used to be in banking for quite a while, so I used to build businesses, most recently as a managing director at Citi. And before that, I used to be CEO of a tech company in the US. And I do a few other things. In addition, I write a blog called Disruptive Finance.
Okay, good morning. My name is John Matonis. I'm one of the co-founders of the original Bitcoin Foundation in 2012. I have many other roles. I'm also a co-founder and chairman of Globitex.com, which is a new digital currency trading platform for Euro and Bitcoin. And I'm also the vice president of corporate strategy for nChain, which is a new blockchain startup company based in London.
All right, so before we get started, a quick question for the audience. How many people here don't know what a blockchain is? Oh, I call bullshit on that. No way.
I think you have to ask it the other way around.
Yeah, all right. How many people here know what a blockchain is? All right, now a little bit more honesty. All right, so before we get started, I guess I can start us off with, 30-second, what is a blockchain? First blockchain came from Bitcoin. It's basically a distributed ledger that records all the transactions or activity of a network. It's a database architecture that's distributed to many different nodes so that each participant in the network can validate all the transactional history themselves without having to trust a third party about what transactions are valid. It started in Bitcoin, but it has now morphed into many more applications in many different networks with many different structures. So, all right, that's a bad job of explaining, but I did my best. So, John, it's 2017. Blockchain technology has been around for quite a while now. There's been over $1 billion invested into blockchain startups. Where are our blockchain production applications?
Well, first of all, blockchain production applications depend on how you look at it. A lot of the proof of concepts at large financial institutions and corporations are still at the proof of concept level. I want to point out, though, the difference between public blockchains and private blockchains, because the majority of my comments are going to be related to public blockchains. Public blockchains are open, global, permissionless, and you have the global interoperability. A private blockchain would be something that would be permissioned, so someone, in other words, would have to grant you access. It wouldn't necessarily have the global interoperability because they're usually used in private, cloistered environments. So an easy way to think of it is the internet in the 1990s versus the intranet of the corporate intranets that wanted to seal off and cloister their environment because they were afraid of the Wild West internet. So that's the first distinction that I think we have to make. In terms of going mainstream, when you look at public blockchains, the financial applications within the Bitcoin blockchain in many cases have already gone mainstream, at least at the financial level for financial settlement. And I want to point out an application in Bitcoin gaming. Bitcoin online gaming, for the last 2 or 3 years, I would say that Bitcoin as a gaming unit, gambling currency, has already gone mainstream. A significant amount of volume on the Bitcoin blockchain is related to online casinos. And another fact that a lot of people don't know is when PayPal went public, about 70% of their volume was related to adult entertainment and online gaming. So it starts in those areas first before it expands out into the rest of the use cases.
So to differentiate a little bit here, one of these, the public blockchains are a consumer-facing application. Private blockchains are enterprise-facing.
Well, the public blockchains could be enterprise-facing as well. It's just that we haven't seen the production-ready applications for that yet, and that's because we haven't seen the maturing of the scripting language. We haven't seen the scaling that will allow it yet for public blockchains. We're just starting to confront those issues now with scaling, but every blockchain will have to confront those issues.
And Huey, you've deployed new technologies at an enterprise level inside of banking systems. Can you talk a little bit about what that process has looked like? What is the adoption cycle? How long does it take? And where do you think distributed ledger technologies and blockchain fit in that adoption cycle?
Yeah, definitely. So if we take a step back, last year, 2016, 2015, I think we were at peak blockchain hype. And everybody was talking about blockchain on the public side being implemented at the level of financial institutions. And so at that time, I had a view that wasn't very popular, which was saying it's going to take a lot of time. It's going to take a lot of time because at that time, blockchain was really at the level of research and development for two reasons. The first one was that the technology wasn't ready yet for that kind of scale. And the second reason is that even if it was ready, it takes a lot of time to implement anything in financial systems. And I go back to your question, which is, I don't know if you know central clearing. Central clearing was implemented in financial systems for what we call interest rate swaps in 2009. 2009, after the financial crisis, the regulator says there's these instruments which are called interest rate swaps, very, very simple instruments. instead of trading between, let's say, JP Morgan and Citi, we're going to trade between JP Morgan, a clearinghouse, and Citi. We just put an intermediary in between. Very, very simple, on one of the most simple instruments that exist. It took 7 years to be implemented. So it took 7 years, not because of the technology, it took 7 years because of the regulation, because of the internal processes, because of the risk management, etc. So it's going to take a lot of time, and as John mentioned, at the moment I haven't seen any public implementation of blockchain in institutions. We're seeing a lot of people working on the private implementation, but not on the initial vision of a public distributed ledger.
And Huey, talk a little bit about what we were discussing backstage about how blockchain architecture has inspired kind of a new design process when looking at building applications in general that maybe extend beyond distributed ledger technology specifically.
Yeah, and I think that's one of the challenges today, which is what is a blockchain? Because we have more or less a good idea of a blockchain. The way I saw the blockchain is really this idea of public distributed ledgers where everybody would be on the same system. So this has really changed the mindset of finance. Before that, before let's say 2-3 years ago, most people in finance thought that you could only do finance with trusted third party. So I sent money from here to Singapore, then I need to go through a lot of different correspondent banks, which are trusted third party. With blockchain, we've realized that you don't need a trusted third party. You can send money from here to Singapore, and you don't really know how it goes, but it goes from here to Singapore, and it is instant, it is free. So that has really changed the mindset of people who design technology in banks. So that, I think, has been one of the biggest impacts you see in finance. So a lot of people now are working on this kind of approach, which some of them might be linked to public blockchain, but most of them now are linked to permissioned private blockchains.
Can I elaborate on that for a second, David? Because I see a lot of clients who are interested in getting into blockchain. They read about it, and they want to know how they can apply it in their business. First of all, the blockchain is about disruption and disintermediation. You can revolve every significant use case around what gatekeeper in the middle is being disintermediated. So I encourage my clients to review their landscape and try to identify which gatekeeper it is that they want to disintermediate. And if they do that survey and they can't find anyone, then usually it's them. And this is the case with companies like DTCC, with Euroclear, with Swift. They look at this disintermediation technology with the realization that they're the ones being disrupted.
So
That's a true statement.
Yes, I agree. So, talk a little bit about maybe some of the hurdles here that on an enterprise level, blockchain technology has seen. It seems that, a distributed, decentralized technology may not be compatible with a highly regulated industry like banking. Is it that the pain points that we see in the financial system really stem from financial regulation? And in that case, is blockchain going to be able to find a home there?
Well, we're seeing this play out jurisdiction by jurisdiction. And I think what will ultimately prove to be true is that the new entrants in things like financial services will not be the financial service companies themselves. And you really, for that to evolve, you really have to look at it by jurisdictions, because the regulatory environment is different as you go through different jurisdictions. For instance, in Africa, they have the opportunity to leapfrog a lot of things and go directly to P2P mobile payments without the architecture of the operators, the government, and the banks all getting their slice of the pie. So you can't just look at it in terms of the Western economies.
So what do each of you think is the most compelling decentralized technology when it comes to blockchain?
Yeah. Perhaps I'll come back to your point about disruption and what is disruptive. Because I fully agree that the idea of blockchain or Bitcoin was a very disruptive idea of trying to build a financial system on different rails, basically. And I don't think it's happening today. I think that what's happening in blockchain is not disruptive at all. I think what's happening is that we've had this disruptive idea. You don't need to have a trusted third party. people started from this idea and trying to do things at large scale like R3. So R3, a lot of banks getting together and trying to rebuild the payment rails, for example. That hasn't happened. So, and what we're seeing in the case of R3 is that they're changing basically in their mission into not we're a blockchain provider or we use blockchain, but we try to improve the financial system by using whatever kind of technologies are available. And I think that's what we're seeing today is that started from this idea, this mindset, which is we can do things differently. Very, very good, because a lot of sectors we never looked at before, like payments or custody or clearing, suddenly we had a lot of money, we have a lot of resources getting into those spaces. So a lot of people trying to see how they can improve that. And now we're at this stage where people are trying to improve those sectors which used to be very, very boring. But I would call that almost like technology as usual. We have found different ways to use technology, and we're trying to apply that. So I think we've lost the disruptive part of blockchain at the institutional level. It doesn't mean that it's bad, because I think that there's a lot to do in terms of improving the financial system, but it's not disruptive. For me, the disruptive part still comes much more from the Bitcoin and cryptocurrency part than the blockchain applied at the financial institution.
All right, so before I ask my decentralized application again, what year do you think we're going to see institutional deployment of blockchain technology on a large scale, production level scale?
Well, for financial applications, we'll see it by 2020. I can't predict at the enterprise level smart contract stage. It's too blurry. But I have a follow-up, though, on... I'll let you go first.
So last year I said in 10 years. So I don't know if I would say 9 years today or not. And that again, that depends on what do we call blockchain. Distributed ledgers, public, etc. I don't know. It's going to take a lot of time. Now, for example, DTCC, implementing some kind of ledgers within a private network for clearing of credit default swaps, that might happen quite quickly. Again, is it a blockchain or not? I think it's blockchain inspired, but it's not really the initial vision of blockchain.
So I'm gonna make a calendar reminder, and in 5 years' time, I'll come back and ask.
And 3 years for me. So.
3 years for you. All right.
No, but in terms of the decentralized P2P applications, we won't exactly know when it's mainstream, but there will be some clues that we can point to. One of the clues will be that the part about the Bitcoin blockchain, or the part about the Ethereum public blockchain, will become transparent to the users. So they may be doing transactions on top of something, on top of an app, and they may not realize that the blockchain is even being used in that. I think that's an important clue. And there's 2 startups in that area that I wanted to mention because they highlight how you can have the Bitcoin blockchain framework in the background without the consumers even knowing it. One of those startup companies is called Abra, A-B-R-A, and another one is called Epiphyte in London. Abra is essentially an application that works like Uber, but for money remittance. And you don't even necessarily know that you're using Bitcoin in that case. The same thing with Epiphyte. They're doing global cross-border transactions, essentially with a Bitcoin backbone and APIs to handle the liquidity in and out of Bitcoin.
Do you have one?
So I think there's the example of Ripple. Ripple, for me, is a good example because Ripple started really a few years ago. It was really cryptocurrencies. So Ripple was a good example of cryptocurrencies, then talking about blockchain. And what Ripple is today, I don't think it's a blockchain, but it's an information system on top of existing payment rails, basically. And so that's the kind of transformations we've seen, which are quite interesting. Really started from cryptocurrencies, then this idea of distributed ledgers, blockchain. And what they do is that now it's an information system on top of existing core banking systems. So that's the kind of evolution we've seen. Again, is it going to be blockchain or it's not blockchain? I think one of the main things we're seeing is that big blockchain, I think was last year or 2 years ago. There's going to be a financial system which will be totally different, a bit like the internet, TCP, IP, etc., that will redesign the way we do finance. I don't think that's happening at the moment. I think we have gone past this peak blockchain hype, so which starts to be a bit more boring. So people will talk less about it, I think, because we're really talking about technology, we're talking about IT, we're talking about framework within large banks, which how many of you really are passionate about core banking systems? No, not that many.
So I'm going to answer my own question. I think there's two projects that everyone in the room should be watching this year that are going to be coming to market. One is, well, the rumor mill is saying it'll come to market within the year, but is PBOC coin, so the Chinese RMB in digital form on top of a blockchain issued by the Chinese central bank. The other project to watch is prediction markets. There's two large prediction market decentralized technologies out there. One is Augur, and the other is Gnosis. And I'm pretty sure Gnosis, I don't know if anyone's ever said this before, but Gnosis right now, I believe, has the record for the highest valuation per employee of any company in history, surpassing WhatsApp. It's, I think, on the market right now, $9 billion, and I think they have 8 or 9 employees. Not bad, not bad. If anybody's here questioning your job and whether you should start a decentralized technology, that should be an indicator. So, segue into what I think is probably the most topical, most interesting topic of the time, which is the tokenization of these networks and the tokenization really of just securities in general. And I think there was a pretty critical event that happened within the past year, which was Bitfinex, which is one of the world's largest cryptocurrency exchanges, was hacked and lost $90 million. And in order to compensate their users, they issued a token called BFX token, which they redeemed every BFX token for $1. And they issued those to their users. And effectively, that was the first debt offering in the crypto space for $70 million. And the total cost of them to do that debt issuance was less than 50 grand. And majority of that was spent on legal. Well, they paid everyone back. No one's going to jail. And they did a $70 million debt offering for 50 grand. There's enough bankers in the room. You can do the calculation on what your firm would charge to do that on the primary market. It's significantly more. So I think that was a pretty interesting experiment for tokenization of a security, and everything worked out okay. And if you look at the market right now, this ICO phase is just going mania. I mean, we are seeing projects raise $35 million in 30 seconds. What is both of y'all's take on the ICO mania?
Yeah, I'll start with that. I mean, you're right. The Bitfinex token is a great example. We probably wouldn't be talking about it if it didn't work out so well, but as an alternative to bankruptcy, it was a brilliant move, and it's now retired, and it was a single-purpose issuance. So aside from prediction markets, I think that the ICO market, the initial coin offerings, has emerged as the killer app for Ethereum. I don't think anybody would have really predicted that. I think it's so early and so new that there's just so much that you have to be careful of in the space. First of all, it totally changes and transforms what investor rights are. So your investor rights won't be the same as they would be with a typical IPO or with a crowdfunding. And you could also have a potential situation where the company does very well, but their coin or their token doesn't do as well. And I think these issues need to be addressed before it can really take off as a mechanism.
Do you have an opinion?
Yeah, ICOs are very interesting. There's a company, I'm on the board of the Supercharger, which is one of the largest FinTech accelerators in Asia. And one of our companies actually raised money 2 weeks ago. They raised $2 million in a day, through an ICO. So quite interesting because, as a startup, raising that amount of money in such an amount of time, it's totally different. And you mentioned, disruption. Definitely, that is the kind of disruption that I think is still very, very early on. So we don't know where it's going to go, but that's actually the kind of methods which are very interesting to think of, a bit like crowdfunding a few years ago. It's just different ways of doing finance, and that could be there could be a lot of potential, but we're still early days.
So Huey, you talked earlier about disruption, but Bitcoin really has developed in parallel to the existing financial system rather than trying to just disrupt the financial system. This ICO market is really developing in parallel to traditional financing, fundraising opportunities. What do you tell the institutions in the room that are seeing the triple-digit growth and the large amount of capital that's flowing into that space, but who can't touch it because it's not in the bylaws of what they're even able to invest into, or they can't touch it because of the regulatory issues? How does an institution get exposure to that market in today's regulated environment?
Change jurisdictions would be one answer. Work with jurisdictional arbitrage. But for the ones that do the issuance, and I know several companies that are thinking about it because it's the flavor of the month, figure out a way to protect investor rights. I think that's the most important thing.
Yeah, and for large organizations, in general, that's the issue of disruption in general, not just about Bitcoin or blockchain, but disruption. And the way for them to do that is that first they need to understand what's happening. So a lot of them have invested into blockchain mainly to improve their core infrastructure. But this part, which is not this part, outside of financial systems, most people don't really look at it. And as you said, that's something that can be big quite quickly. So just being aware of what's happening. Still hard for a large organization, of course, to be invested in that space.
So I think ICOs in the past 3 months have raised more money than they did in all previous years. Last prediction, are ICOs going to be bigger or smaller 12 months from now?
I think they will be bigger, but I don't think it's sustainable.
I think that all depends on the price of Bitcoin. So if Bitcoin is bigger, it's going to be bigger. If Bitcoin is low, it's going to be low.
Or price of Ethereum.
Or Ethereum.
Yes, totally agree. All right, well, that is all the time we have today. I hope that was enlightening. You only have 5 more years to wait before we can see some enterprise scale blockchain applications. So see you then.
All right. Thank you.
Thank you.
Next up, we have our panel of experts look at the most recent implementations of new technologies within wealth management and how this is impacting market exchanges. Is this a sure step to improving the approachability of the trading and investment world? Let's find out. Please join me in giving a warm welcome to Reuters' Eric Oshard in conversation with Goldman Sachs International CIO, Joanne Hannaford, founding and managing partner of R3, David Rudder, and founder and CEO of eToro, Yoni Asiya. Thank you.
Hi, everyone. Our panel today is going to focus on first where we are in the technology of trading, of asset management, of investing, and then move through some of the changes being brought by blockchain, and then finish up with a discussion of how different investors are taking more control of their investing. So why don't we start with some introductions? Joanna, you want to?
Yeah, I'm Jo Hannaford. I'm the head of technology for Goldman Sachs in EMEA. And I'll talk a bit about why this is a relevant topic for me. So financial services is being disrupted everywhere. And it's incredibly exciting. It's an incredibly exciting time to be a technologist. I'm a computer scientist. I've been programming for 25 years. So I want to talk today about what we're doing to respond to that disruption and how we're really embracing it.
Well, maybe, we were talking earlier, people think of Goldman Sachs as an investment bank or a bank.
Yeah.
Tell us what you think from inside the company. What is your core business?
Yeah, so Goldman Sachs, if you think about it from a technology perspective, our core technology platform is pricing and risk. That's what we really do. That's our proprietary framework. And that has really two emphases. Anything that's not risk and pricing, we could really commoditize. So in terms of back office functions, AML, KYC, that could really be a utility. That doesn't really help our client franchise in any way. That's something we have to do for other reasons. And so we're really risk and pricing. And the second thing is that the appetite for our client base to interact with us, new clients are forming. So everyday people want to interact with those risk and pricing functions in a way that we haven't seen before. And how we open that up and how we present that to kind of potentially a new client base is a theme that we are seeing.
Great. David, you want to talk about R3 and sort of where you're headed?
Love to. First, let me introduce myself. I'm David Rutter, the founder and CEO of R3, which is an enterprise software company based on a platform called Corda, and hopefully everyone's heard of it. If you haven't, I encourage you to go to Corda.net. I've been on the street for 32 years, which is kind of fundamental to my story. My last gig was 10 years as the CEO of BrokerTec and EBS. And because my entire career has been spent working with big financial institutions, I was very impressed by some of the promise of Bitcoin and other early crypto technologies, but then really thought about how that mattered to global finance and worked with the industry to build and design the operating system for the future of finance in the cloud. And so I look forward to talking to you about everything we're doing. I'm very excited about what these new technologies will mean for the future. And part of what we're going to talk about today is wealth management and how it ties in. There's a lot of interesting innovation going on there, and I think platforms like Corda help empower young entrepreneurs to bring creative new applications to the market.
So when you talk about your customers, are you talking about integrations with major banks and fund firms, or who are your customers?
Yeah, and this is integration to current systems is actually fundamental to Corda and the way we think about things versus just the introduction of a new technology like a Bitcoin, Ethereum, or even IBM's Fabric, which use creative new technologies, but they're incompatible with today's current systems. So Corda was designed by, for, and with the largest banks in the world, and it uses familiar software and technologies like SQL databases and Java, and we've thought deeply and written white papers and worked with our members on how exactly we can integrate into today's system for that difficult transition period to the future when everything is done in the cloud.
Got it. Yoni, you want to?
Yeah, hi, I'm Yoni Assi. I'm the CEO and founder of eToro, which is the world's largest social trading network. We have over 6 million users from 100 countries who trade stocks, commodities, indices, currencies, and cryptocurrencies like Bitcoin and Ethereum. And everybody can see what everybody's doing. It's a public social network, and people can automatically copy the top investors in the network, which is a form of money management 2.0. So you can find investors from all over the world and simply copy them with your money. You invest $5,000, it'll automatically copy all of their trades into your account and then trade automatically in your account. So if you find a good crypto trader generating 200% returns, all you need to do is copy them to generate the same returns.
So tell us a little bit.
Simple as that.
Yeah.
Simple as that.
Yeah,
Simple as that.
In some places that might be called market manipulation, but it's an interesting, interesting concept.
Tell us a little bit about the assets your investors hold. What's the split in terms of traditional stocks, bonds, currencies, and cryptocurrencies?
So traditionally, we've seen a lot of our investors are investing in technology stocks. So by far, the most tradable stocks on eToro are Google, Apple, Amazon, Netflix, basically tech stocks. So people like to invest in what they believe in, to invest in companies that they understand, and good stocks that generated 40% returns on average in the past 4 years. What we've seen over the past 6 months is a huge surge in the amount of people coming to eToro to buy Bitcoin and Ethereum. And today, actually, people hold on eToro more Ethereum and Bitcoin than they hold tech stocks. So we've seen sort of a flip there where people are super excited about, obviously, the surge in prices. We just yesterday, market cap of the cryptocurrency world hit $100 billion market cap, and the price of Ethereum alone, I think, went up 20x the past 3 months. So obviously, we see a lot of people interested in that. And also relating to what Joanne said, I think the appetite of consumers for risk is very different. Most of our users are millennials, and they're interested in taking risks that are not the traditional risks that investors would be taking.
Why don't we talk a little bit about what exists right now, and what are some of the issues as you try to embrace new technologies and disrupt the kind of traditional trading? What are some of the things holding you back? Maybe you could talk a little bit about...
I think that the viewpoint that I represent is an organization which is 150 years old, 32,000 people, and we've been working along certain operational principles which are changing. And so let me just give you some color into that. We're 32,000 people at Goldman Sachs. Last year, the new analyst class that we brought in, 40% of them were from STEM-related backgrounds, so science, technology, engineering. 11,000 people at Goldman Sachs are computer scientists. That's a big change that we've seen over the last decade into the kind of makeup of our workforce. But in terms of these themes around how a different type of consumer wants to interact with financial services, there's 4 challenges or opportunities, and we really talk about them as opportunities. The ability to develop applications and present them externally in a way that's safe and secure very quickly. So we've done that with applications such as Simon. The second thing is the digital experience that we're presenting to our consumers. I mean, finance has traditionally been a voice interaction, an analog interaction with our clients. That's changing. A decade ago, we had 600 equity traders. Now we have 3. So we're used to that type of rapid automation, but this is different. The richness and the kind of interaction that we have with that type of consumer, so the development of those types of applications, operational risk, thinking about the uptime and the operability of our applications and how we think about those applications. The fact that we would be competing with firms where they have 100% resiliency. Now, obviously, we do have that in certain places, but not everywhere. And I think, finally, engaging with startups in a way that helps being part of that kind of ecosystem of knowledge. And that means for financial services, less so for us because we are like this naturally, but being part of this ecosystem and engaging with it so that you can actually form that kind of development and disruption and kind of embrace it. That's something. I mean, we do that with companies like Kensho and Digital Reasoning, but that's something that not everybody in financial services does. I mean, there would be the 4 pillars that I would describe.
So talk about how your client base is evolving. I mean, there's traditional Goldman customers you'd think of as money managers, hedge funds. I mean,
highly
corporates.
Sophisticated clients, right?
Exactly.
So
talk a little bit about...
Yeah, I mean, I think of our client base. I mean, this is a huge generalism, but largely, individuals or corporations. One of the common attributes of our existing client base is that they're very sophisticated, have a large knowledge of and expertise of financial services. and can participate in ways which are highly customized and understand the kind of risk and pricing services that we provide. We're thinking about this new set of consumers that want to interact with us, and how would we interact with them? Their level of sophistication is different. They have a huge appetite for risk, and we're cautiously looking at this. I mean, we see it as an opportunity. There's obviously an appetite to deal with us. And I would say that we're kind of just thinking through what that really means in terms of how we present, what type of interface, what type of services do our traditional services and products apply, what type of products do they want to really realize?
Right.
So when we talk about the challenges of kind of deploying new technologies in a financial services world, we have to realize, and it touches on something Joanna said, her firm is whatever, 130 years old.
150.
150, sorry. You never want to underestimate Goldman Sachs.
150.
So many of the systems that are at the core of global financial services still rely on Pascal and Fortran and really ancient technologies. But as you touched on, they work. And it is it's a very big risk, and you have to be very careful when you try to migrate off those systems. So what the street's been doing for the last 20 or 30 years, since those systems were introduced in the 70s and the 80s, is building kind of applications around them. And blockchain and distributed ledger technologies, for the first time in a generation, give us an opportunity to rethink all of that and move on to a new platform where we can have rapid introduction of new technologies. So when you look at Snapchat and you look at some of these social media firms, it's not like there's hundreds of years of financial practice with hundreds of global regulatory regimes that have to be adhered to, that you're dealing with trillions of dollars of people's money every single day. So there's a good reason why these technologies are so annoyingly sticky and hard to change. But I really think that the reason everyone's so excited about distributed ledger technologies is the light bulb's going off, that for the first time, maybe we can finally shake that legacy infrastructure and move to cloud-based finance where the industry shares the expenses for these non-proprietary back-office systems.
But as you said, a lot of your work these days is actually helping your big clients get from where they are to
where we are,
to the greenfield future. We'll get to you.
No, but yeah.
I mean, talk a little bit about the timelines for how blockchain begins to take over the various processes that define the market these days.
Sure, notwithstanding everything I said and the fact that every senior executive understands how sticky and annoying their system is, the way finance works is they want results tomorrow. And one of the most difficult challenges for us is to kind of manage those results. So really quickly, we will see some live and deployed distributed ledger technologies this year that will make an impact on the edges. I think mostly around end-of-day trade data, trade information warehouse with the DTCC as a project that we're involved in. So we're going to see that on the edge. I think next year is going to be a very big year for the deployment of these new technologies. And then you can look at 2019, where I think it's making a big enough impact that it might show up in a Goldman Sachs annual report as providing significant enough savings to get a mention.
Got it. So,
well, for us it's different. We're a consumer technology company. So onboarding to eToro, so a lot of the things that obviously from risk perspective are very different at Goldman. On eToro, every person here in the audience can open an account in 60 seconds and fund his account with $200 with his credit card and buy Bitcoin, which will be basically traveling on the global blockchain in 60 seconds. I think what we're seeing as we're looking into the blockchain space, specifically in blockchain assets and the revolution, the way we're looking at it, first of all, this technology is, in my opinion, as big as the invention of electricity, the computers, and the internet. But I think that the people, the community of people that are investing in Bitcoin and Ethereum are believers that they will be stakeholders, they will own part of this infrastructure of the internet. This is like in 1995, somebody came to you and said, you want to buy shares in TCP/IP. And the people that are buying Bitcoin and Ethereum and other cryptos believe that they can own this infrastructure, and there's a big question whether that'll materialize, whether the infrastructure will be built bottom-up through public blockchains with people investing in them and making money and profiting on them, or with big banks taking private solutions like R3. I mean, or both, by the way, probably both. Yeah. So it's super interesting to see how this develops.
I think you've described yourself also in comparison to Goldman Sachs. Just talk a little bit about what you think of yourself as a trading platform.
I think we eventually, so we're a customer of Goldman, and we appreciate their services a lot. So we consume a lot of the services from Goldman and then basically divert them into our clients. But if you look at the experience, we're actually serving more clients than Goldman. So we're first a consumer technology company, constantly iterating around the experience of our users with our application. How good is their experience? Let's develop that more. And then the second priority is pricing and risk management, which we basically, a lot of it is being outsourced to Goldman and the likes of Goldman. So we basically we're building eToro on the shoulders of giants, whether it's Bitcoin or Ethereum in the blockchain space, or what Goldman does at pricing and risk management in the traditional currency stock market space.
And I think this is the interesting point there is that this whole theme that we hear about financial services becoming more open and more collaborative, right? Blockchain is a huge opportunity for us to do that. You know, it's you know, in a macro level, you could describe it as a secure ledger where participants of a transaction know each other and are authenticated. So how we take advantage of that is really about openness and collaboration and bringing things up easily that allows you to have more of electronic interaction. The same principle applies to your point, which is if we could actually have interfaces of our systems that allow us to either present them directly to consumers or present APIs to our risk and trading platforms through something like eToro, that would be something we can explore for many, many financial institutions. The technology uplift to achieve that is very daunting. But for us, with such a large engineering base and for a population of our staff which have an understanding of engineering or science, that becomes more and more reality. But that's really a huge macro theme for us, is what's our services and what's our core services and how do we present them? And your point about the client base is important. Today, we have clients. Our first business principle is the service we provide to our clients. That's number one business principle for us. The integrity and ethics and protecting that relationship. Well, if those clients suddenly become hundreds of thousands of more people, how does that apply to those people? And we want to not dilute that. We want to protect that principle. So that's a huge consideration for us as well. And that's why we're optimistic but cautious about how we take advantage of these new trends.
So Yoni, you have some news today. You're launching a cryptocurrency copy fund. So you're really kind of carrying
our copy fund product that we released last year is basically a digital portfolio management product. So people can invest in thematic investments on eToro, whether it's our big tech copy fund, which allocates it through technology stocks, our big bank copy fund, which allocates it through big banks, or our top trader copy funds, which uses artificial intelligence to automatically copy the top traders on eToro. What we've seen over the last couple of months is people are super interested in investing in cryptocurrencies and Ethereum and Bitcoin and others, but they don't necessarily want to constantly manage those positions, understand how market cap is changing, how to allocate it. So we've created the cryptocurrency copy fund where people can actually invest in the copy fund on eToro, and what they're investing in is the market cap weighted average copy fund where we automatically rebalance their positions in Bitcoin and Ethereum, and we're going to launch soon several more cryptocurrencies. So you can basically invest now in a crypto copy fund on eToro that invests for you in various cryptocurrencies and you don't need to worry about sort of what's happening. You will take care of basically the allocation and the exposure to it. And we're actually just launching this today here.
So you've talked about your core business being trading and risk. How do you, I guess for all of you, how do you help clients in a market environment that this year is, everything is up, but the volatility looms? It must, because that's what history tells us. Cryptocurrencies, Bitcoin are what, at $3,000 levels. How do you protect investors on the downside?
I think our point of view is knowledge and information. So we try to make sure as much as possible that our customers are aware of the risks. But there again, you know, we're Generation Y, no risk, no returns, no risk, no reward. So people, if they want to participate, if they want the upside, they need to take that risk and they need to understand it. But if you can generate 20x returns in 3 months, that means you can lose 98% in 3 months as well. So people just need to be aware of those risks and decide and risk capital they can afford to lose. And in my opinion, again, being a part of the trading world, so I've been a trader since I was 13 and a computer programmer, but being a part of that world is connecting at the deepest level to what runs our entire world, which is economics and finance.
The only thing I would like to add, because we don't have a lot of time, is someone who ran the largest FX trading platform and U.S. Treasury trading platform, is there is a tremendous amount of risk. They are not fiat currencies. They are not backed by governments. They're not backed by any asset. And the trading volume is ridiculously thin. It's not easy to get in and out.
That's not so true. That's a $4 billion a day volume in cryptocurrencies is not that thin.
Compared to, say, $5 trillion.
But there's no institutionals.
I'm just saying it's just a high-risk game. So it's just a word of caution. I'm excited about what eToro is doing. But as someone that's been on the street for a long time, I just thought I wouldn't mention that. In other words, think before you run out and start buying cryptocurrencies.
Great. Thank you. We need to rush you off the stage. I think you have another panel at the other stage.
Perfect.
Let's get going.
Thank you.
Thank you very much.
Thanks, everyone.
The banking system of tomorrow is being built from first principles today, much in the same way that Elon Musk built SpaceX and Steve Jobs designed the iPhone. Here to outline that we are building today and why most traditional banks won't survive to see it, let's give a huge welcome to author, innovator, and CEO and co-founder of Moven, Brett King.
So I'm often accused of being a futurist. I don't know if you've heard the definition of what a futurist is. It means never being wrong today. You've got to think about it, I know. But the dark art of prediction as a futurist involves really looking at the trends, the macro trends and the micro trends that could affect an industry like banking moving forward. Now, when you want to think about where banking is going to take us in 20 to 30 years, often we might look at analogies like, say, how the Luddites responded to the steam engine. And we see parallels with that with Uber and how taxi drivers responded to the disruption that Uber represented. 200 years apart, but the response of those workers was essentially the same. So there are strong parallels. So I was looking for an analogy to say, where is banking going to be in 20 to 30 years? What are the changes we see now that might redefine the way we think about financial services in the next 20 years? And so I'm going to talk to you about rocket science. You probably heard the expression, banking isn't rocket science, but we can learn something from rocket science in respect to the way that's changed. Now, when we talk about the technologies affecting banking, we really have to start with, sorry guys, the clicker's not working. Could you go to the next slide? We really have to start with the mainframe computer as the primary artifact for banking in terms of technology disruption. Now, when the mainframe came along, it was actually interesting. We're going to go back a little bit. When the mainframe came along, this changed banking pretty significantly. It was the introduction of bank account numbers was as a result of the mainframe, because prior to that, we used to put customers' records on an index card in the branch. When the mainframe came along, we couldn't sort customer details by their name, so we had to give them an individual number. That's where the bank account was created from, the introduction of this technology. The next major technology in banking was self-service banking. And this was supposed to end branches back in the 80s when ATMs came along, but it wasn't like that. But it did change our dynamic in terms of our expectations of banking. Now we could do some of our banking without requiring to see a human. Now today we're in the experience era where we're starting to push banking and financial services to customers in real time. And this is once again changing the dynamic. But let's look at the design philosophies that are impacting the world today. We talk about two primary design philosophies in terms of engineering. One is design by iteration or analogy, and the other is first principles design philosophy. Now, to understand first principles design philosophy, we can go back to World War II and the V-2 rocket. Now, at the end of the Second World War, the V-2 was the primary piece of technology that sort of was the height of World War II. And as the war drew to a close, the Americans, the British, the Russians were rushing to capture the top German rocket scientists, 1,500 of them, on this blacklist for the US. And at the top of that list was the name of one guy, his name, Wernher von Braun. Now, Wernher von Braun became the architect of the US Apollo program. Now, at the height of the Apollo program, each launch would cost about $1.2 billion, and it cost us about $6,000 per kilogram to get a kilogram of stuff into orbit. Pretty expensive. And for 50 to 60 years, we iterated on the V2 design and then the Saturn V design, and over 60 years, we got the price of that down by about half. But along comes Elon Musk, and in just 14 years, using first principles design philosophy, Musk has been able to create reusability, and we're now within sight of a $300 per kilogram cost to orbit. That's a 95% reduction from the days of the space shuttle. This has come about by rethinking the way we think about rocket design. If you were going to start from scratch today, would you build a rocket the same way they built it during World War II? The answer is obviously no. We look for other products that use first principles design, and the iPhone is an excellent example. Prior to the iPhone coming along, you might have had one of the Motorola flip phones or the Nokia banana phone or a BlackBerry. Steve Jobs didn't take those phones and iterate on them. What he did is started from scratch. Johnny Ive and Steve Jobs used to carry around a block of wood to understand how they might interact with a device like this. And this is how they started to think about the design properties of the iPhone. And of course, since the iPhone, everyone's iterated on that. So how does the banking industry compare with, say, Elon Musk or Steve Jobs from a design perspective? Well, when the iPhone came along, there was an obvious opportunity to think about payments and how money could be instantiated on this new technology. But instead of creating an entirely new payments architecture based on this new context or experience, what we did is we put plastic cards inside the iPhone. This is designed by analogy. So when we look at banking, what we've tended to do is we've taken products like the credit card or products like the bank account and we've iterated on them. But there are examples of first principles design in financial services. Today, the most successful deposit product in history, the most successful savings product in history, is Yuebao in China. They raised $93 billion in deposits in just 8 months. I mean, this is more than the entire personal capital markets in China today, to the point where China has now put controls on this because it's been so successful. But in doing so, Yuebao, Alipay, Ant Financial showed us that mobile was the best deposit channel in the world, far better than the branch had ever been. But this breaks our design thinking in terms of iteration on the banking model. Now, we've talked about banks and branches of the future and all of this stuff when we talk about where banking is going to go. But the problem is not really a design problem as much as it is a behavioral shift that we're seeing. We can optimize the design of branches, making them more colorful, put coffee machines in, put technology in there, but it's not getting customers back to the bank branch because they just don't need to go to the branch today. Why? Because they have these devices. They can do most of their banking on these devices today. So the only way you get people back into a branch is not redesigning the branch, it's taking their iPhones and smartphones off them. And that's clearly not going to happen. So it's not a design issue here, it's a behavioral shift. And the problem banks have is we think of everything in terms of the branch. When the internet came along, we took paper bank statements and we put them online and we called that internet banking. And when the mobile came along, we iterated on that again and we took the internet banking and we said, how do we put it on a smaller screen to fit on a phone? This is this iteration thinking. Even to the point where Ross McEwen, the CEO of RBS at the time, said, our biggest branch is the 701 from Reading to Paddington. This is the way banks think about this. Every new piece of technology comes, we're iterating on the old branch model. We're iterating on the old products. But we are starting to see real changes in terms of the way banking's embedded in our life. When Uber had to solve the problem of onboarding drivers quicker, instead of going to banks and partnering with the banks, they issued a debit card within the driver's app, because that was the fastest way to get drivers onboarded. 30% of Uber's drivers in New York and Chicago and San Francisco had never had a bank account because they'd been working in the yellow cab industry on a cash basis. And the biggest thing that stopped Uber recruiting new drivers was having to wait for them to get a bank account. So Uber solved this by embedding the bank account process in the driver onboarding app. Uber's not a bank, but they now do leasing. They offer a debit card for their drivers. This is the embedded banking experience. We're seeing banking surface as a utility in different platforms and experiences now. And this is where banking's most useful, when it can solve a real-time problem around money. So when you look at things like WeChat emerging in China, you see an example of a payment experience that doesn't correlate to an existing payment product. It doesn't link to a 16-digit PAN. It doesn't require a magnetic stripe. It's a new paradigm. It still works as a payment vehicle and a value store, but it's experiential. It's not product-based. So when we see new experiences emerge, this is our impulse savings product for Movin'. We're trying to figure out ways to get people to save behaviorally now. There's no fixed deposit, CD, traditional savings product behind this. Now it's a behavioral approach to the savings problem rather than a product and channel approach. Now, how this is going to change the way we think about design is that we're going to have to start thinking about the way banking will be embedded in people's lives and reframe the utility of banking as an experience rather than a product through a channel. And that's a significant mind shift that most banks aren't yet prepared to take. Now, I want to illustrate this using an example from Amazon Echo, Amazon Alexa. I guess some of you have seen this ad, but this is Alec Baldwin demonstrating Amazon Alexa.
Yeah.
You're okay. He's okay. He made it.
Jason, what do you mean?
We were very bad boys.
Alexa, what's in the news?
Here's the news.
Alec Baldwin and Jason Schwartzman were seen mooning paparazzi. Baldwin grew a shoe at photographers before making a run for it.
My poor cashmere socks. Alexa, reorder another pair of Brescianis.
Reordering Bresciani socks.
Okay, listen. Can you send some lawyers or something? Alec.
So this is a pretty good analogy for the future of commerce. As AI becomes more embedded in the world around us, we're going to start to use agency to conduct a lot of our commerce. In fact, by the middle of next decade, it's estimated that between 50 to 70% of our regular commercial transactions will be handled by our own agent, a personal AI. So that's not very long away. We're talking about 10 years away. But think about that. If you think about this commerce transaction, do you remember what Alec Baldwin bought? What did he buy through Alexa? He bought socks, right? Bresciani socks. They're $200 cashmere socks. My guess is Amazon probably paid for them. But so he bought these socks. He said, Alexa, reorder me a pair of Bresciani socks. Which credit card did he use to buy the socks? This is where you start to really think about product design. Do you think that a promotion for airline miles on a MasterCard this month would change his behavior? Would he say, Alexa, reorder me a pair of Bresciani socks, but use this MasterCard that's got higher airline miles this month. Let me give you the 16-digit number. Do you think that that's the way the interaction is going to occur? Absolutely not. So if you're in a credit card department right now thinking about this, not only is plastic going to disappear, but the differentiation of that product is completely going to disappear in terms of this experiential world. In fact, the credit card department is going to disappear because now we don't need that. We need contextualization of credit, contextual payment experiences. This is a design shift that's pretty significant from a banking perspective. So then we come to the real question is, where do humans fit into this architecture? Because we've often thought that the real differentiator humans will have is the ability to give advice in this space. But actually, when we look at AIs as a platform, the sort of advice we're going to get from AIs in terms of our finances is going to be very personal. It's not going to be product related. It's not going to be you need this asset class or you need this type of mortgage. It's going to be, hey Siri, can I afford to go out for dinner tonight? No, not after the drinking session you had with Nadeem on Saturday. That was crazy, dude. You know? So this is the sort of advice that's going to be built into our day-to-day financial lives. But already we're starting to see AIs that outperform humans at advice. IBM Watson is able to outperform human doctors, cancer specialists, 2-to-1 in terms of accuracy of cancer diagnosis. We have identity algorithms that Customs and Border Patrols use that banks are now using, such as selfie and facial recognition, that outperform humans by 20 to 30 times, which means the riskiest thing that banks do today is account opening face-to-face. It's the single riskiest activity banks do today because humans are really bad at facial recognition compared with software. But this is the real differentiation. When we talk about artificial intelligence and you build this into something like a self-driving car with a LiDAR rig, this can see 1,000 times more information than our human eye can take in because it's a 360-degree field of view and it can process that information in 70% faster than your neocortex. So statistically speaking, once this technology is mature, no human will be able to be as safe as an autonomous vehicle in terms of driving. Why? Because of the ability of the AI to synthesize data and make a decision based on that data. And the same is true for a robo-advisor. The same is true for a money coach built into an app. The same is true anywhere that advice is given in financial services today. A human will not be able to compete with AIs because of the ability of AIs to synthesize data in real time and apply it to you personally. So ultimately, where we come out with this is that as we redesign financial services based on first principles design philosophy, we get a very different outcome, where humans don't add value in a real-time experiential world. When you're surfacing the utility of banking in real time to solve someone's problem, if you stick a human in the way, you just slow down the process. Elon Musk says about the Tesla factory that the reason they don't have humans on the Tesla factory floor is they have to slow down the production line to human speed. In the financial services space, the organizations that differentiate themselves in 10 years' time will be those that can deliver revenue and relationship in real time, experientially. You put a human in the way, and it reduces it to human speed. So the options bank have out of this is that there's really three choices that we have as a banking partner. To partner with a fintech, to acquire a fintech, or to try and copy what a fintech is doing. Now, which of these is the best? Obviously, the cheapest and fastest option is to partner. Mimic is the longest and most expensive. Why any bank would rebuild what a fintech has built today, I have no idea. The reason being is fintechs consistently can deploy capital much faster and much more efficiently than an incumbent bank. So if you're in the banking space today, the only real outcome, if you want to create these experiences, you want to create this new layer of banking, is to work with the technology players and fintechs that are innovating in these experiences. I just don't believe that incumbents will be able to keep up with the rate of innovation that's happening in the fintech space and technology space today. So who are going to be the winners out of this? When we look 20 to 30 years' time, or even in 10 years' time, who are going to be the leading financial institutions in the world based on this shift away from products and channels to experiences where banking utility is embedded in your life in real time? Who do you think is going to be the leader? Well, by the middle of next decade, there's going to be a financial institution that is on track to 3 billion customers globally. They're going to be worth about $500 billion, twice what ICBC is worth today. And it's not going to be a bank. It's going to be Ant Financial. By the middle of next decade, this will be the largest financial institution in the world. And it won't be a bank. It'll be a technology company. So if you want to compete in this space in the future, you can't be a bank either. You have to be a technology company. That's the only way you stay relevant in this world. So if you're looking for more information on this, I would just say to you, if you are going to start from scratch today, building the banking system from a first principles design perspective, would you really start with buildings that require someone to go and sign a piece of paper to then give them a plastic card or a paper book to do their banking with? Is that how you design the banking system if you started from scratch today? Well, just like Tesla and SpaceX, just like the iPhone, absolutely not. Thank you very much. Check out Breaking Banks, my FinTech podcast, and make sure to check out Augmented as well. Thank you for your time today, and enjoy the rest of Money Conference.
So, next on stage, we take a look at innovational lessons learned from emerging markets. What can a truly global footprint teach the financial sphere about sustainable banking models? And how does this differ dramatically across the globe? Let's give a huge welcome to the Financial Times' Karim Shuba in conversation with Deputy CEO of global banking giant Societe Generale, Bernardo Sanchez-Incera.
Great. Well, thank you all for joining us. Thank you for being here.
Thank you.
Let's start with something that I've been very interested in. M-Pesa started a trend in Kenya with mobile payments. It's continued with WeChat in China. Why haven't we seen the same sort of technologies in more developed markets like Europe?
Well, what's going on in the less developed countries is that you don't have there any infrastructure. So when you want to solve to provide a service or to solve a problem, you tend to go directly to the state-of-the-art technology. So since in the African countries you have an incredible penetration of the mobile phone, the basic tendency is to use the mobile phone as a mean to develop the services. And what happens in the more mature countries is that before you adopt the new technologies, you have to get rid of your infrastructure. And this is that refrains you from moving very fast.
So in the sense that banks like yours have a lot of legacy infrastructure in developed markets which aren't there in the emerging markets, which means it's more difficult to advance.
Well, you do have the infrastructure, but you also have the customer habits, the customer usage. We do have millions of customers and services that we provide on a daily basis. So when you are in that mature environment, you have to, most of the time, move step by step because of the infrastructure, the customer habits, all the utilization you have around.
Go on.
Sorry.
So, it seems in countries where a lot of people don't have banking services, where there isn't a widespread presence of retail banks like yourselves, we see that innovation more. And is that because the customer habits haven't been formed, because the infrastructure isn't there already?
Well, when you take, let's say, a typical sub-Saharan country where we operate 15 banks in sub-Saharan countries. You have banking penetration, it's on average between 10 and 20%. So most of the people are not in the banking sector. So when you are a guy working in Dakar and you are sending back money to your village on the other side of the country, if you do that on the traditional way, which is with physical money, it takes a lot of risk, time, etc. So when you enter this sector and you are a bank and you want to provide a service and answer to this kind of needs, the easiest way to do is to go for the normal usage of the country today, which is the mobile. And it's very easy to implement a system by which, through the mobile, you can move the money around the country. And you don't need to establish any additional infrastructure. You don't need a lot of effort and investment to do that.
I guess, what I'm trying to understand is, so the technologies, the basic technologies that they have in Dakar and other parts of Africa, we also have them in Europe.
Yes.
So we have great connectivity for the most part. We all have smartphones, and generally we're wealthy people, and certainly wealthier than a lot of these countries in Africa. So then why haven't these more seamless forms of payment, why haven't they appeared in Europe as they have in Africa?
Well, they have, but the market share is very limited today because you have the card system, which is very efficient, is not very expensive. You have all the traditional systems, which are widespread and work very, very well. When we are talking about the mobile penetration in less developed countries, we are not talking about a very significant market share. Today, even in countries where the usage of the mobile is significant, most of the transactions are made in physical money. So what is interesting is that the adoption of the newest technology is faster than in mature countries. But we are not yet in a situation where a majority of transactions are done on an automatic mode. This is probably something that will happen in some years.
And what, in the markets that you work in different parts of Africa, have there been innovations or new technologies or new ways of doing financial services that you have then used in more developed markets and,
Yes.
and vice versa?
Yeah, for sure. And this is one of the things that are interesting in a group like Société Générale, where we are operating in 40 different countries. We've been, well, today you cannot feel that as like an innovation, but we've been doing transactions through the mobile in Madagascar or Cameroon since 2010. We were paying invoices through the QR code system in Cameroon in 2010 or 2011, and nowadays we are introducing that in the French market as an innovation for the French market. But we are 4 or 5 years after what we did. We tested. In some cases we failed, and we changed the systems. But we were able to test the technologies in real life, not in a theory, but in real life.
And is the reason why you're able to experiment more in, say, those markets that you described, is it because in those markets there's market share for you to gain, as opposed to, say, in France, where you have market share to defend? I mean, do you have more flexibility because there isn't as much banking in those markets?
Well, what's going on in some of those countries is that we are contributing to officialize the economy. And banking penetration is not just a banking thing. Banking penetration is also a signal that someone becomes an official entrepreneur, and then you can have access to the credit, you can grow, you're becoming a much more official economy. So what we are doing in those countries is that we are contributing to normalize the economy. By doing that, we are increasing the share, the size of the market and the market share. That's why we envision Africa as one of the locations where we have the more growth potential for the group. But this is not opposed to what we do in other countries. In other countries, what we do is we are changing our systems. We're investing to innovate and modernize our systems so that we adopt progressively the state-of-the-art technologies.
But is there a reason why you're able to experiment more in these emerging markets?
Well, it's easier because the size of the risk is more limited, and the time to market is faster. I mean, you can almost immediately have a situation where you can test. We are introducing at the moment a bank which is based only on the mobile in 6 different countries in Africa, based in Morocco, and we are doing that in a very, very short time period.
The problem of there not being access to financial services in various emerging markets is one that we've known for a very long time. Société Générale has been present in these markets for decades and decades.
Yes.
Why is it still a problem? Why hasn't it been solved?
Well, for many reasons. One of them is that technology was not there, and the investment which was needed to spread or to develop the banking sector was much bigger before. Today we are doing let's say in Senegal, we do have a model of bank which is called Manco, by which we use scooters to go to the place where our customers are, and we can. So instead of having branches, we have scooters. We send our people to the villages or to the places where the potential customers are, and then we open the accounts without any physical presence. This is something which is feasible today thanks to the technology, and it was not feasible a few years ago.
And so, because one of the reasons why you're not able to serve certain customers, or you don't have certain customers, is just economics, right? they're not profitable for you to have as customers.
No,
Is that
this
fair?
is also because you have to educate people, to train them, and to make them feel and understand that to make their transactions official is positive for them and not negative. Some of them are cautious about becoming an official agent in the economy, and we need to educate to explain that by becoming official, the member of the official economy, as we can say, you are paying taxes, that's true, but you are also getting access to the services, you are getting access to the credit, and then you can go and build something which is solid and which can last for a long time.
I guess the thing I'm curious about is part of why you're able to innovate and do more banking in these emerging markets is because they're becoming richer, or has the technology changed the fundamental economics of which customers you can serve now?
I think it goes both ways. The technology, you have to invest to be able to provide the service, but the size of the investment is usually more limited, and the cost of each transaction is lower. I mean, in the past, until recently, we were very efficient at doing things on a bureaucratic way, which is very costly to operate. If you compare a transaction operated through paper and people, and you compare that to any transaction done through digital, I mean, the cost of the two are totally different.
Before I came here, I spoke to one of my colleagues. He covers Southern Africa, and he said to me, in a place like Zimbabwe, it costs you like $30 for a gigabyte of data, and people can only take out $50 a day from their bank anyway. And so he was wondering, well, if we're talking about fintech, there's very basic banking problems that don't have much to do with technology that still need fixing in a lot of these countries. Do you think that's right?
I don't see the basic service that you need to operate can be delivered for a very, very limited cost, very limited. Until people have the capability to have some savings, they really need the banks for just a few transactions. But as you increase the number of people who are active around the bank, you increase the number of people who will be demanding more sophisticated products, more sophisticated service, and you enter into a positive cycle which will contribute to develop the economy around you. I mean, the banks have been, and if you take even the history, the foundation of Société Générale, the main purpose was the bank was created by a group of entrepreneurs to develop the economy. That was the idea of the bank. So if you remain in that same logics, as you develop the service and you develop your contribution, you develop your capability to take the savings of the people to help other people to invest, you are contributing to develop the economy. And by that, you are doing things that will benefit also the bank, but we are to the profit of the countries where you operate.
And do you think as you provide more banking services in these countries, as they become richer, is the banking that you'll be doing entirely branchless? Will it be like the digital banks that we now see in Europe, or will it be like a limited branch network?
For the moment, in the less developed countries, we are still opening branches in some cases because you need a place where you can make people feel that the bank exists, and a place where you can educate people. But then, for the transactions, the bank is not very very important. And as the digital transactions increase and the physical transactions reduce, then the physical presence of the bank is less and less necessary. But not today, because today you have at least 85–90% of the number of transactions of a country which are made in physical money.
So you still need somewhere that people...
You need branches.
And how much is Société Générale, how much is it learning from what it's doing in Africa? I mean, I understand, or in parts of Africa,
Yeah.
I understand you have like a number of accelerators that you founded in various places.
Yeah, we have an accelerator in Dakar, in Senegal, because when you are in a landscape which is not fixed, there is a lot of initiative, a lot of people who have ideas. So what we do there is we bring them the capability to test their ideas and to provide potential services to our customers. So we are having a very positive momentum there.
And how the question I always have about accelerators is how much are you learning and how much are you making sure that a competitor isn't going to come out from nowhere and disrupt your business?
No, we have really an open mind today, really. So my idea is today the more you help people to have ideas, the more ideas you get back. And well, probably there are people in the room which are part of that, but I tend to think of all those initiatives as a very big R&D department for the bank. So we support them when we can. We get their ideas. You have a lot of bright people who identify specific services that we don't cover properly. So this is a challenge for us, but it's also a direction for us because there are a lot of technologies that are moving very fast, and we don't always see the potential of a technology which is appearing in another industry.
Just a final question, because we're running out of time. So a couple of months ago in April, Jess Daly, the boss of Barclays, he said, and I quote, I don't think that small fintech companies are going to challenge us. And he said, I'm not concerned that new technologies will harm Barclays. Are you concerned that fintechs are going to challenge Société Générale?
Listen, a few years ago, a very rather old banker told me, I was coming into the industry a few years ago, and an old banker told me, don't worry, we already know what banking will be in 20 years from now. It was 5 years ago, 6 years ago. I think it was wrong. I mean, I feel not threatened, but challenged, because we have to acknowledge that there are a lot of bright ideas, or a lot of people who are addressing specific needs of our customers. Maybe there is no a global offer, but a lot of specific offers. And if we don't make the effort of being on the right timing, at the right level, if we don't cooperate with them, for sure there's going to be a lot of problems with the bank. The other thing is that we should be able to adopt everything which is new in terms of technology. But the constraint, which is a positive one, is that we already have 30 million customers that we are serving every day, and that we need to continue to serve them, and simultaneously we need to invest so that we go to the state of the art. So I think this is one of the most exciting moments for the banking sector in history, because what I know is that what banking will be in 3 years from now is not yet invented.
Great. Well, we're all out of time. Thank you so much for being with us, and thank you.
Thank you.
Good.
past 12 months have been a fintech roller coaster. Our next panel will take a look at late-stage growth in successful fintech startups. Just what is the state of the FinTech IPO in 2017? Please join me in giving a huge welcome to Laura Noonan of the Financial Times in conversation with partner at Propel Venture Partner Jay Reinemann and Chief Financial Officer of iZettle, Maria Heidengren.
Good afternoon. The FinTech IPO is arguably the most exciting moment in the life of a FinTech. We're hoping this will also be the most exciting panel of your day. So this is up to these two people joining me here. First I'm going to kick it over to Maria, who is in the very interesting position of being a FinTech, which is now assessing all their options around actually doing an IPO. So could you tell us a little bit about your situation, Maria?
Yeah, so iZettle has actually been recently appointed the number 21 on Europe's most rapidly growing companies in Europe. So we are a hyper-growth company that started in 2010, and we believe that we're in a really well position at the moment as a fintech company. And we are considering an IPO for next year, potentially. It's one alternative that we're exploring at the moment.
And could you tell us a little bit more about the company, what kind of things it does for anyone in the audience who isn't actually familiar with it, and what makes you think now might be a good time, or now or in the next year might be a good time to IPO?
Yeah, so iZettle, it's a commerce platform. We're present in 12 countries, 10 in Europe, and also in Brazil and Mexico. And one part of our offering, which is the bigger part right now, it's card payment processing offline for small merchants. So our customers are around maybe 1 up to 10 employees. And we also have an offering in terms of providing point-of-sale solutions for surf pads and for mobile phones. And we also have other related products around that, card readers. And we also have a product launch which is offering short-term working capital lending to our customers. And why we believe it's a good time to talk about IPO right now, or to plan for it, it's in the northern Scandinavia, in Sweden particularly, since 2016, it's been a very favorable climate for IPOs. Last year, I believe it was up to 80 companies that went IPO in Stockholm. So it's a bit different trend compared to when you see Western Europe, where the trend has actually been going the other way around. So Scandinavia is attracting a lot of capital right now. And we have a fully funded business plan, but we believe when we talk to the investor community, including investors like institutions, that they're very interested in iZettle in general.
And sitting next to you, I guess we have part of the investor community. Jay, welcome. So you were previously involved probably in one of the biggest FinTech IPOs when you were at Visa, and you're now on the investor side. How do you see the climate today?
It depends on which part of the world you're really thinking about. In the U.S., and particularly also what kind of company you're thinking about IPOing. We've seen that certainly, of course, the lending market has seen the biggest challenges just because of what's happened with the most recent ones that went out, Lending Club, and that didn't work out so well. What we've mostly seen is some of our companies are looking at longer runways and looking at alternative options other than the IPO, just because there's so many later stage investors.
Yeah.
I think.
So you don't really need to IPO.
Yeah, I don't think you need to as much as you used to. We've got so many late stage investors like a SoftBank that's willing to take out us as the earlier stage investors. I'm curious if you've had any of that, maybe with iZettle, or maybe you can talk about it.
Sorry, about?
If you've had some exits from with your early investors through a secondary?
No, not really, no.
Okay. Certainly an option right now, just because the runway for most companies is enabled with these large investors.
And when you think of yourself from the investor perspective, do you prefer to exit through selling it on to a latter stage investor? Is there more certainty there than if you go through the IPO route, or how do you kind of view the two options?
Equal. I mean, we're looking on cash returns. So if we can get a great exit from some secondary, it oftentimes, from a venture capital perspective, you also have to think about the business. And so we work on IRRs. And so to the extent that we can get in a little bit of an earlier exit, maybe it's not that large IPO, but still has a great IRR, it's good for the business.
And Maria, when you think about IPO from the perspective of the firm doing it, how important is it to be your own boss effectively, to not have a kind of a big shareholder group who's kind of over you? Is that a big factor in your thinking?
I would say it's one factor. I mean, of course, you can get great institutional investors and venture capital investors as well who give you that same type of freedom. But, clearly that's one advantage of being a public company, that you can attract capital but still remain in control within the senior executive and the board about the strategies of the company.
There's a certain amount of cost you have to go through. Can you talk about that at all?
Well, we believe it's going to be a positive investment, of course, so yeah.
Have you looked at the Spotify direct listing? Have you seen this?
Yeah, there's a lot of writing about Spotify up in Sweden, yes.
If that's a potential option. I don't know if, Laura, if you've thought about it also.
Can you tell us a little more about that for anyone who hasn't looked at it?
Just Spotify is thinking about going through a direct listing instead of going through the banker process in the hopes of saving some money, basically. Interesting option. The potential, there's a little bit higher risk because there's not going to be the same sort of coverage, the pre-sale trade-off. Just
but
curious.
You avoid all those big bank fees.
Yeah.
And when you think about the timing of your IPO, Maria, how important is it to have reached, what are the key business milestones that you want to have reached first? I think you guys aren't actually profitable yet. Does that matter, or would you...
I think it's important for us to continue our growth path. And we are considering an IPO next year, but it's subject to the market conditions at that time, of course. It's one very possible option, but it doesn't have to end up that way, depending on what happens. But we believe we have a really nice growth trajectory. We are very well positioned in the macro trends around digitalization and what role we play there.
But I guess growth is all well and good, but at some point, top-line growth has to be met by an actual bottom line that actually makes people money. So, Jay, how do you, as an investor, view the trade-off between rapid growth, but then actually proving that something can be profitable?
I think there's a fairly well written path for this. I mean, from an IPO perspective, most of the bankers are looking for that top-line growth and an understanding that at some point, if you turn off, usually it's turning off marketing, that you can turn off marketing and then become profitable long term. So it doesn't really matter in the short term if you're losing money, as long as you're able to grow the top line.
I think someone told me that it's somewhere around 40-50% growth trajectory is where there is some kind of trade-off. Like if you grow 50% and up, then there is an acceptance that it will cost money to continue to gain market share and to grow that fast. But when you start going down to 40 and below, then the market expects more profitability. Of course, in any IPO, you have to explain to the market how the underlying business is scalable and profitable, but that it's the investments at the moment to continue to grow that fast, but that the underlying business has the potential to earn money. That's clear.
And how important is the overall fintech investment climate? I think we saw from a KPMG report last year that overall globally funding for fintech IPOs fell last year, having gone very well in 2014, 2015. Do you need to have a good fintech market or just a good domestic stock market, or how do you think about those two things?
Well, for us, we think about the overall climate in Scandinavia. That is where we would go public. And the people we talk to, investors like institutions, venture capitalists, other type of investors, they have a high interest both in the fintech space, but also in the tech space and high growth investment opportunities. So, the report you talk about, we see other trends that speaks in favor of an IPO, that the IPO window in Scandinavia is still wide open, actually. That's what we hear also when we talk to people.
Jay, how do you see it? Do you think that 2017 will be a good year or a bad year in terms of fintech IPO volumes?
I think it can only get better. Let's hope. But like I said, there's lots of options out there for companies to choose. And for us, the IPO is probably let's hope maybe 10% of our companies go through an IPO. For the most part, it's expected that these companies are going to go through some sort of trade sale. We even had a company, I don't know if anyone's following the ICOs, in an initial coin offering. Anybody? Okay, a few. I mean, it's a geeky world out there in the Bitcoin world. But one of our portfolio companies, a company called Brave, last week Tuesday, they raised $35 million in 24 seconds. And they probably had enough interest in this ICO, they probably could have closed 100. Interesting.
Yeah, could you explain to the audience who aren't following ICOs what an ICO is, just for the others?
An ICO, it's actually a really interesting concept. So this company, Brave, first of all, is a browser company. And they enable, of course, what browsers are mostly used for is to enable a publisher and an advertiser to connect to you, to get your attention. And this particular ICO, or initial coin offering, is being used to enable a coin that's going to be the trade vehicle for enabling the publishers and the advertisers. And so companies are raising this money as sort of a groundswell opportunity for the consumers, the users, to participate in the ecosystem. So instead of the VCs only being able to participate in these companies, it's enabling the everyday individual to participate in these ICOs or their similar IPOs. However, it's not equity. So in this particular case, this company that raised $35 million, there was no dilution. The challenges, though, there are, of course, governance.
Yeah, I'm kind of concerned about the regulatory space. I mean, are these people covered by investor protection if they're not equity?
Yeah,
or
so
is
far, it's been interesting to watch. It's so new. We've been waiting for the SEC in the US to have a saying on it, but right now it's an asset sale. So these companies, they're selling...
So it's unregulated, effectively?
Effectively.
Would you be interested in that kind of a way to raise finance? Would that be kind of a viable alternative or a viable complement to the IPO?
That's not something that we have been considering at the moment.
Because it's too new, or... I'm sure Jay could email you on some stuff on it.
Yeah, I don't know. It hasn't been in the discussion so far. Who knows?
Yeah, the majority of the companies that are doing this are really early stage.
Yeah.
That this is, and they're usually some sort of digital currency component to their business. I think you're probably a little bit farther.
Yeah.
In terms of success and failure, how do you judge a failed fintech IPO? And have you seen many examples of that?
Well, from my perspective, that's pretty easy. Am I going to be able to exit after the lockup where there's actually a profit?
That's pretty much it. So you aren't too concerned about how it trades afterwards, or if the
no, of course.
valuation.
Yeah, no. So after the lockup period, is the still going?
Can you still get out? But then, as soon as you've exited, is that where you're concerned about it goes, or if the company subsequently proves to have been overvalued?
Well, philosophically, we want to make sure our children survive.
But financially,
Yeah.
And in terms of your perspective, Maria, what makes for a successful IPO for you?
I think it's about being transparent and clear in explaining our business to get the right valuation and make the investor community understand our business and the potential. And then executing, I'm part of the executive team. We need to execute on the plans to deliver on expectations and to be managing to make sure it's not a huge expectation gap. It's what it's all about to execute, I think.
It's a trade-off. I mean, every management team is going to decide, all right, do we want to go through this? because of the compliance, the audit, all the stuff that you don't really want to do as a public company, the extra scrutiny that you have, the quarterly reporting, it doesn't sound so interesting anymore. And when you can go to a Fidelity or someone that's going to bring in, or a SoftBank that's going to give you an extra runway and not have to deal with that stuff that you are actually, as the CFO, going to
you know, I hear what you're saying. I guess my history has always been with public companies. That's been my entire career. And of course, there's a lot of administration and cost, but I also see benefits in being a public company. You can be actually more transparent and clear to the stakeholders externally. They will receive ongoing, thorough reporting on how the business is going, and it helps in terms of recruitment, recruiting talent, because the company becomes more visible and they can really read up on the company. And it becomes more clear for any major supplier and partner how are we doing. It's more transparent and it's easier to communicate. And I guess the company on the map. So I also see a lot of advantages being a public company.
And I guess it will also allow you to accelerate growth either through acquisitions or
Absolutely.
investment.
But I mean, there are other opportunities to raise capital for growth, of course, besides IPO. But I think some of the benefits of IPO, there are benefits of being a public company.
And would you see yourselves only listing in your home market, or is there any benefit to an international listing, so listing in London as well, or those kind of dual listings?
At the moment, we're considering only listing in Stockholm for various reasons. I know like Spotify and others are considering US, but our product isn't available in the US, so we believe we're kind of an unknown company there. It doesn't make sense. UK is actually our biggest market at the moment, so we have been talking about London, but to be honest, we're kind of a small company compared to a lot of the companies that are listed in the UK, and as an investment case, I think we're more well-known in Stockholm, so it makes sense to start there in a way, but who knows what's in the future.
And how important is the listing venue, Jay? Because we see a lot of the Chinese fintechs are now listing in New York rather than at home.
It depends on how much liquidity you need, and what's I guess, just like you said, is the brand something that people are familiar with in the market where you're going to be selling? I think it's a good choice for you.
We might throw it out there to the audience for questions. We have about 5 minutes left. If anyone has any questions they'd like to ask Jay or Maria. I think we have some people with microphones roaming somewhere. Any questions? Okay, I think we do not have any questions, so we will come back to our panel Q&A. So, Jay, can you tell us a little bit more about the companies in your portfolio and where they are in terms of exits? So you said that you've just had one ICO.
Yeah, we've had one ICO. We've got another one, a company called Civic, that's probably going to raise something similar to that. Again, in this ICO world, some of our later stage portfolio, we've got DocuSign in our portfolio, also kind of in that exploratory stage. I probably can't say too much about it, but they're looking at their options, and they're definitely at the stage where both their growth rate as well as their EBITDA margin is at a place where they could do it.
And when you say they're looking at their options, how does the decision making work between the owner and the company itself? To the extent that you have a VC in there who has a significant chunk, can you influence the options, or is it ultimately?
You can. It's a collaborative process. I mean, I don't think anyone really wants to force something too fast, just because I mean, as you probably know, it's just not. If it's not market ready, it's not going to make any sense in the long term to the exit. Most of the companies we've seen. It also a little bit depends on the funds that are in there. So some funds have a little bit more pressure to return capital. Unfortunately, that's sometimes a little bit of a conflict of interest, I think, for the long-term benefit of the portfolio company like iZettle. Hopefully, you're able to diffuse that kind of pressure if you've got that with some of your VCs. The better ones, of course, don't have that kind of pressure.
So Maria, in terms of your situation, is it being driven by the shareholder or by the company?
I think it was actually a couple of years ago when the founders, Magnus and Jacob, who are also active in the company at the moment, they had a discussion with the board and said, we can take this company profitable now, but the board, who are also represented primarily by the venture capital, the major venture capital owners, said, this looks like a real growth opportunity and a potential IPO candidate. We think you should continue to invest in growth and have that in mind if it makes sense a couple of years down the line. So I guess we have their support that this is one possibility that seems to be right for us at the moment.
And in the event that the market conditions aren't right and you decide to not IPO, will that have a big impact on the momentum of the firm, because everyone's kind of getting excited around the IPO?
Oh, I don't want to speculate in that, but no, I don't think so. There are other opportunities out there, both for raising growth capital, I would say, and I think it's also, it's a positive thing for the company, even though it's hard to go through a process like this. The company is at a stage where we need to sort of streamline some of the things that we're doing anyway. So I think it's going to be a healthy process either case.
You can't bank your future on it. You need to.
No, absolutely not.
Because I guess an IPO can offer the staff more ownership. Is that how would it be structured in a way to give the staff more of a stake, or the staff already?
We have a warrants program, a stock option program for employees already as it is at the moment. So a lot of the employees are actually having a stake in the company.
Yeah, but they'll just have a more liquid stake, I guess.
Yeah, of course.
Well, and hopefully in an opportunity to buy in a position where they may not have gotten in part of their ownership as part of their employment. They didn't get exactly what they want, and hopefully you're able to give them some parts of the IPO.
But like I said, we have a business plan right now that is funded. So going IPO, we believe it's a window right now that will remain open for yet a while, where we could attract really good growth capital. But if the IPO doesn't happen, then we don't see that it's going to have a major impact on our way forward. We're going to manage it anyway.
Okay, well, thank you very much for that, and the very best of luck with it. I think we're just about out of time, so thank you very much, Jay. Thank you very much, Maria, and thanks, guys, for listening.
Thank you.
Thank you, Laura, Jay, and Maria for that. This next talk brings us right up to our lunch break, where after we will hear from Blockchain, DBS, MasterCard, Adam Bank, Credit Tech, HSBC, BBVA, and many more in a very exciting closing afternoon here on MoneyConf Center Stage. Now on stage, we have an established leader of the once tumultuous alternative lending space, focusing on how marketplace lending is really doing and his predictions for the next 12 months. Let's give a very warm welcome to Bloomberg's Ed Robinson in conversation with co-founder and CEO of Funding Circle, Samir Desai.
Hello, everyone. Good afternoon. It is my pleasure to welcome you to our panel discussion on the resilience of peer-to-peer lending. My name is Ed Robinson. I'm a senior writer with Bloomberg News. I'm based in London, and I cover FinTech. And I'm very, very pleased to have Samir Desai, the CEO and co-founder of Funding Circle, with us today to talk about the peer-to-peer lending model. Funding Circle specializes in making online loans to small and medium-sized businesses. It's the #1 platform in the UK. It also has done about over $3 billion in origination since it started in 2010 and operates UK, US, Germany, and the Netherlands. So welcome, Samir.
Thanks.
Resilience in the peer-to-peer lending model. Since I've covered FinTech, there's long been a lot of naysayers, a lot of critics, a lot of skeptics who have looked at peer-to-peer lending and said it's not sustainable, it can't last, it's how can this work? The big banks will squash it. And in 2016, that became kind of a test year. We had the Lending Club fiasco in the United States. That's the biggest platform in America, which had a corporate governance issue or two and had a few bad months there for a while. And then, of course, we had Brexit in the UK, which raised all sorts of economic uncertainty. I think everybody held their breath in the industry after Brexit for a spell, but